All right, let's get right into it. There's something big brewing in the market, a huge potential shift that's happening right under our noses. We're going to talk about a move away from those high-flying growth stocks we've all been obsessed with and look at one investment that might be sitting in the perfect spot to catch this next wave.
I mean, this sounds about right, doesn't it? For what feels like forever, the entire conversation has been about finding that one stock that's going to go to the moon. It's been a wild ride for sure, but the source material for today's explainer poses a really critical question.
Yeah, what if the music's about to stop? This is the core idea we're digging into today, the chance that the market is getting ready to hand the baton from these speculative growth names to something, well, something a lot more solid.
So, are there any actual signs that this party is wrapping up? Well, after the unbelievable run we've seen, there are definitely whispers that a new kind of market cycle is just around the corner.
You'll hear this term, rotation. It's just a fancy way of saying a big shift in where investors are putting their money. For years, all the cash has been flooding into tech and AI. But, history tells us these things don't go on forever. The pendulum always swings back. And it looks like it might be swinging back towards value. Stable, profitable, maybe kind of boring companies.
Okay, so if we're all leaving the growth stock party, where's the after party? Let's meet the star of our show today, what some might call a boring, but maybe, just maybe, a very smart alternative.
Meet SCHD. It's a Schwab U.S. Dividend Equity ETF. And its whole game plan is, honestly, refreshingly simple. It buys solid American companies that have a hardcore, proven track record of paying dividends to their shareholders for at least 10 years straight. No exceptions.
So how does a company get into this ETF? The source uses this fantastic analogy. Think of SCHD as a bouncer at the most exclusive nightclub but for dividends. To even get in line, you need that 10-year-plus history of paying dividends. Then the bouncer checks your fundamentals, your cash flow, your return on equity. Then it checks if you've been growing those dividends. If your financials aren't rock solid, you're not getting past that velvet rope. It's that simple.
And when you're that strict, you end up with a portfolio that looks way different from the rest of the market. There's no speculative tech here. Instead, you're looking at the backbone of the economy. We're talking industrials, healthcare, energy, financials, businesses that, as the source puts it, actually make money doing useful things. And get this, here's one of the best parts, the price tag. The expense ratio is just 0.06%. Let me put that in perspective for you. For every $10,000 you have in it, you're paying just $6 a year in fees. That is practically free. It means your money is working for you, not getting eaten up by fees.
Okay, so SCHD is a solid, low-cost fund. We get it. But why is now the time to be talking about it? This is the most important part of the argument, so let's get into the why now.
I absolutely love this analogy from the source because it just nails the choice we might be facing. For the last couple of years, it's felt like we've all been in the AI casino, right? It's all hype, all momentum, chasing these crazy explosive gains. The argument here is that the next 2 years could belong to the dividend diner, a place where you just sit back, relax, and get served regular, consistent cash.
So why would that shift happen? It comes down to this really powerful force in markets called mean reversion. Basically, it just means things tend to return to their long-term average. And right now, the gap between how well growth stocks have done versus value stocks is historically massive. Mean reversion says that gap is likely to snap back like a stretched rubber band. And that means SCHD's recent underperformance might actually be the very thing setting it up for a big comeback.
And here's the kicker. While you wait for that snapback to happen, you get paid. Right now, SCHD is yielding almost 4%. That's a solid stream of income, better than what you'd get from a 10-year treasury bond. And unlike a bond, the dividends from these companies can actually grow over time.
And it looks like the market might already be sniffing this out. The source points to a recent one-month gain of over 8%. Now look, 1 month is just 1 month. It doesn't guarantee a trend, but it's a pretty powerful signal that sentiment might be starting to turn.
Now this is even more interesting. Short interest, that's the amount of money betting against SCHD, dropped by over 60% in that same time frame. A drop that big tells you something important. This isn't just small-time investors changing their minds. This suggests the big institutional money,
The smart money is rotating in, seeing SCHD as a safe harbor.
And finally, here's the potential rocket fuel. Everyone is watching the Federal Reserve, waiting for them to start cutting interest rates. And as this fantastic quote says, when that happens, assets that produce income get hot. Really hot. Like your grandma's casserole coming out of the oven on a snowy day. When it's cold outside, that's exactly what you want.
Okay, but let's be real. No investment is a sure thing, and it's super important to look at the other side of the coin. So let's do a quick, honest reality check on the risks here.
So the source points out three main things. First, SCHD is pretty heavy in energy stocks, and those can be cyclical. The counterpoint, you're getting paid that nice 4% yield to ride out any bumps. Second, what if the growth party just keeps on going? It could happen, but the bet here is on that powerful force of mean reversion. And finally, dividends get taxed. The simple fix for that is to consider holding it in a tax-advantaged account, like an IRA or a 401k. Let those dividends grow and compound tax-free.
So, after all that, what's the big takeaway for you? How should an investor think about something like this? Let's zoom out and look at the strategy.
Well, there are a few ways to approach it. For some, it could be a core, stable holding for their entire portfolio. For others, maybe you make it a 10 or 20% slice of your portfolio to balance out all your growth stocks. If you're near retirement, it's obviously a great source of reliable income. And hey, if you're worried about getting the timing exactly right, you could always just dollar cost average your way in. No stress.
You know, a lot of people worry about being too early on an investment, but I love how this quote reframes that. When you're buying something that pays you cash just to own it, being early just means you start collecting those dividend checks sooner.
And really, that's what this all boils down to. It's about a potential shift in focus. A shift away from chasing the latest hype and towards building a portfolio of real, tangible assets that put actual money in your pocket.
So the source leaves us with this very direct, very provocative final thought. A call to action built on a belief in quality, in income, and in the idea that the market cycle is about to turn. Buy it, hold it, let the rotation do the rest. And that's the whole argument in a nutshell.